businesses are coming onto the public markets larger and larger and larger in the
Oh yeah.
US. Airbnb went public at an $80 billion valuation. Uber went public at 50 something. These European companies or these international companies don't have that same access to the venture capital and private markets. So they have to go to the public markets for their investment. So not only are we getting bigger potential, smaller cap, and like way more of those type of companies in international markets, but they're not being ring fenced by venture capital, by private markets at all compared to the US. And this is another reason why there are so much green shoots in international markets. Emmet, how are we getting on?
Hey Mike, how you doing? I see there's a big outage with Cloudflare as we record.
I was literally just about to say we're lucky to be up and running on this. It's kind of everything and anything was down, isn't it?
It's kind of like when CrowdStrike struck and the world shut down. Earlier on, I just noticed some website I went to was like, check your Cloudflare, and I thought it was at my end. And then lo and behold, website after the other I found was off air. And then I heard you and France were rebooting your Wi-Fi router.
I was there at the modem for about 10 minutes before I realized it wasn't it wasn't my fault, which is a good thing, I guess.
And
Yeah, it's
actually, I thought it
funny.
was there was a comical moment where our CTO sent around Cloudflare's outage tracker, where you can kind of see the mean time to fix, and it also was hit by an outage because it was being powered by
Yeah,
Atlassian's Trello. So so their outage page had an outage as a result of their outage. It was like some kind
same
of episode of the Matrix.
same with that down detector. Do you know a down
Oh
detector?
yeah.
Yeah. So that's down because of the Cloudflare. It's funny. It's funny when it's a business like there was an AWS crash maybe last month or 2 months ago or something, and kind of everyone has some idea of how
Mm.
extensive and important like cloud servers in general are, but they're dominated by the big companies. But when it's a kind of lesser known company like the splash CrowdStrike made 2 years ago when it had its outage, and like seeing the company that the average Joe non-investor wouldn't know a thing about in Cloudflare, and
Mm.
just its kind of general importance to tech infrastructure and kind of what we base our everyday lives on nowadays. Do you know what I mean? It's funny. It actually harkens back. Did you remember we had on Investicon, we had Eric Bleeker, and one
Mhm.
of his picks was Cloudflare, and he called it the toll booth for AI.
That's right. Yeah,
Yeah.
he did.
So
But what I
I
see,
was thinking about that quote when we were seeing all the apps and everything down today.
that's right. Our CFO Hazel just sent a Slack going, ChatGPT is off air, and I'm like, hold on, you're a CFO. You're not meant to use ChatGPT.
I think everyone's using it now. I know this
Yeah.
perplexity was
Oh,
down too.
for sure, absolutely. But I definitely it has identified a window in the market for detector outage detectors for outage detectors. Did that did that land?
It's very, very niche, but we'll
Yeah,
see.
very
We'll look
niche,
into
but
it.
hey, let's do it. Why not? So, oh yeah, I'd like to start by telling our customers, our lovely listeners, to open Apple or Spotify and click on the subscribe button. It won't hurt you one little bit, folks. It won't affect your life in any negative way whatsoever, only positive. So that's always, I'm going to start every podcast by just saying, subscribe to our podcast. It helps us in mystical, magical ways.
Absolutely. Okay, so today we're going international with the whole episode,
Hmm.
essentially. So we are launching Nexus 3 next week.
Yeah.
That might be news to some listeners, to subscribers. I guess this is where you hear of it if you haven't been emailed already. But Nexus 3 is going live next week. It's a really exciting product based on international stocks you won't find anywhere else. And its role is to discover these hidden gems, essentially. And I would be so impressed, even looking back at Nexus 1, Nexus 2, and the stocks we have in store for Nexus 3, I would be so impressed if any investor had heard of these businesses before. Maybe with Nexus 1, some have become a bit more mainstream since then, but just finding these kind of businesses you won't get at valuations that don't really exist in the US anymore.
Couldn't
And
agree more. Yeah.
before we
Yeah.
get into you're going to break down like kind of what Nexus is and everything. I just wanted to go into the kind of reasoning and the importance of not being completely dependent on the US in terms of stocks. I think just to talk like really quickly about international versus the US. If you're listening to this right now, I imagine you own a portfolio of businesses, and I think it's fair to say that the vast majority of those businesses are US based. Obviously, big businesses, they have operations all over the world, but they trade in US dollars. They're dependent on the US economy, and they're overseen by US regulators. They are US businesses. And for the last 10 years, last 15 years, it's been an incredibly good time to own US stocks. They've outperformed international stocks by a distance, completely dominated, like public companies as a whole. I think over 50% of the global market cap is now American. So say the 120 trillion plus dollars of public companies around the world, half of that comes from the US. Nvidia, Microsoft, and Apple are larger than the Japanese and German economies combined. And I say Germany and Japan because they're the third and fourth largest economies in the world. You know what I mean? This is tech related, and the AI trade has definitely exacerbated it in the last couple of years. But just going into kind of where it diverged, I suppose the EU and the US were neck and neck around the time of the great financial crisis. But the difference in, suppose, regulations and access to capital kind of stifled innovation in Europe and rewarded it in the US, which was the big difference. That's where Silicon Valley came, where all the venture capital money went. And you're seeing the kind of fruits of that labor 20, 30 years on from that. But I suppose that's the reasoning. We're not really here to talk about that. The point of this is that these things are cyclical, proven to be cyclical. So going back 50 years, it's kind of been tit for tat between US outperformance versus international outperformance when it comes to stocks. International has dominated the late 80s. The US was completely dominant for pretty much all the 90s, especially in the build up to the dot-com bubble. International stocks absolutely outperformed throughout the 2010s. And then since then, so since the kind of rebound from the great financial crisis around 2009, it's kind of been the longest period of outperformance for the US, about 16 years. And in that kind of time period, we're just waiting for a catalyst to arrive, because with these cycles, there's always a catalyst that kind of ticks it off. A lot of people thought in April, the Liberation Day and the isolationist policies looked kind of like, oh, maybe this could be the trigger here. We saw, especially at the start of the year, European stocks in particular really outperforming. There was a new attitude towards spending in European countries, especially around defense, but across the board and infrastructure and everything else, that looked like, oh, maybe this might usher in a new outperformance kind of cycle. We haven't seen that. We've seen a complete bounce back from US stocks. They seem to be impervious right now. But now we're talking about, say, AI bubble talks. There isn't any reasonable valuation. Whatever it is, there will soon be some form of catalyst, and we will see international stocks outperform again. When that is, I'm not sure. If I knew that, I would be getting paid a lot more than I am now. But the important thing, I think, from this little mini rant is just that I think it's an incredibly important time to look at your portfolio, be kind of quite frank and blunt with yourself, and see, does it need international diversification? Because I think becoming less US centric in the stocks you own is going to be very important in the next decade on. I think Goldman Sachs actually just published a report, and it says that they think international stocks will outperform the US over the next 10 years. So yeah, it's a bit of just a kind of exercise in self-reflection and seeing actually whether you're completely dependent on one economy, because there are over 60,000 public companies out there. There are hidden gems to be found, and that's what Nexus is trying to do. So that's where I'm kind of bringing this back to Nexus III and the launch.
And I think that's a great segue, because you and I just last night decided we were going to each pitch an international stock from a previous Nexus publication. And I think it's going to be a really interesting podcast with two outstandingly good ideas. And just to, I suppose, dovetail to the points you were making, I think our long-term listeners and valued subscribers know that 2 years ago we launched Nexus I, and last year we followed on with the imaginatively named Nexus II. So when we sat down to decide the name for Nexus III, it took a while. It was a couple of days workshopping, but we thought we'd just stick at 3 at the end. Now, to remind people, or for those who don't know, as Mike explained, evidently it's our global stock discovery engine. And when we conceived the product and the idea and spent 18 months to 2 years developing it, it was the fact that there's about 60 what we qualify as first world stock exchanges that are just not disregarded, but not fully regarded in day-to-day conversation and activities. We talk about the Magnificent Seven and the S&P 500, and by association, those 500 companies and the other ones we discussed are either listed on the New York Stock Exchange or the NASDAQ across the road in New York City. But there is a lot of great companies that have never gone near those two stock exchanges. And what we've to remember is a stock exchange is just a grocery store, or as we say here in Ireland, a supermarket for businesses. But the greatest, like LVMH, which we discussed here in the podcast a few weeks ago, is an example of a global mega branded giant that has floated almost everywhere except the US. So we took a look at these 60 plus, maybe 65, 66 exchanges to identify potential market leaders and index beaters or whatever you want to say. And we used AI, who isn't anymore, but back in the day, we had a very cutting edge and have a very cutting edge AI system, very sophisticated screening, which is the traditional way one goes about finding great businesses. They start screening for stocks. So we stuck AI and screening together. We have constantly refined it. And most of all, we've taken expert counsel from a team of advisors, most of whom have been interviewed, or many of whom, not most of whom, but many of whom have been interviewed here in Stock Club, like Bill Mann and Chris Mayer and so on. And we have a load of other clever people who have created vast wealth through stock investing, who have looked over our shoulders. Now, every stock in Nexus gets a Nexus score, which is a score out of 100 that blends quantitative metrics, those kind of metrics that can be expressed with a number like return on equity trend, return on invested capital, revenue growth, insider activity, PEG ratio, and other ones. They're all numeric factors, and they get a 30% weighting. And then we combine those with qualitative human assessed factors, such as the moat. We assess the moat the business has, the management, the culture. And there is a very strong correlation between a high score in Nexus and a subsequent performance. We can now say, because we had Nexus 1 and 2. So you and I, Mike, and our wider, I nearly called you Max. You and I, Max, we need to get a Max. It's a great name. Max Returns. If there's a Max Returns listening, we want you on our podcast. So you and I, Max, and our wider advisors have definitely given the green light to the first batch of stocks for Nexus 3, which is going on sale next Monday. And here's all you need to know about that, folks. Are you listening carefully? When you subscribe to Nexus 3, you will also get Nexus 1 and 2 included. So while you are opening Nexus 3 like it's Christmas Day, you also have all these other presents to look forward to, because the day in the sun is coming for the vast majority of those Nexus 1 and 2 stocks. So you're immediately getting 3 of the services bundled into one for half price. Yes, you heard it here first. You heard it first here, and you heard it right. We are going to offer Nexus 3 for half price, which is $999. And then for that, you get Nexus 1, Nexus 2, and obviously Nexus 3, which is what you're subscribing to for half price for a limited period. Email Frank to guarantee your discount. Frank at MyWallSt. That's MyWallSt.com. And we, as I said last week, we own MyWallSt.com, but I don't even know if we look at that. So email Frank at MyWallSt.com and you will guarantee your discount. And that's all I'll say about that, because I look through the stocks of Nexus 1 and Nexus 2 and they are bangers. They are face melters. So you and I decided to each pick one from either a Nexus 1 or 2. I think you went with a Nexus 1 stock and I went with a Nexus 2 stock. We're going to pitch them to each other. And at the end, we're going to decide, Mike, if you had 10 grand, how would you split it between the two stocks that we're pitching at each other?
Yeah. So I'll kick it off with Nexus 1's best performance stock so far, which was MedCap. And I'm not sure now, that's kind of neck and neck every second day between another stock. We've actually mentioned on the podcast I think must be 2 years ago at this stage. So if you
Mm.
are a really eagle-eyed listener, you can go back and get that. But I won't give away the name of either the best or second best performer Nexus One here, because if you sign up, you'll find it out.
You're about to
So
give away the name of one of the two. So,
exactly, I don't want to give away too much. Basically, is what I'm
uh-huh,
saying. I'm being
uh-huh.
slightly
I hear you.
slightly stingy. But so
And I think the one you're about to pitch is an absolute face melter. But go, go, go. I can't wait to
okay,
hear this.
so the company I am pitching is MedCap.
Oh yeah.
Yeah, if you're getting very excited, it's a very boring
I am.
business.
I love this stuff.
It's a very my style kind of business.
Uh-huh.
So MedCap invests in small and medium sized niche companies, market leaders in the life science industry. It has three distinct areas it focuses on: so medtech, specialty pharma, and assistive tech. Target companies for acquisition, which kind of have a similar makeup in a sense. So you'll have a strong management team with hopefully a majority owner, basically, a founder CEO who owns over 50% of the business, a very clear vision for the future, a competitive advantage in a niche market, and with the potential to grow internationally. It focuses on companies in Northern Europe, so mostly Scandinavia. About 50% of revenue comes from Sweden, 25% from the other Nordics, and then the rest based around the UK and Europe.
And I think it's worth me interrupting because our listeners will deduce perhaps that it is in fact a Swedish company, Sweden.
Yes, very much
So
so.
I don't think you said that. You said 50%
No,
of revenue will come from Sweden, but MedCap is a Swedish company,
yeah.
probably on NASDAQ First North up in Stockholm.
Yes, and we've talked a lot about how much we like Swedish companies. I think it's a country that breeds investors, and because of that, it gets actually a lot of these style of companies as well, where it's essentially a kind of holding company run by investors and set up to invest in, if that makes sense to people. It's kind of I'll give you my money, and I know that the management team is basically investors. They're very focused on returns on investment. And so it takes the pressure off of me monitoring it in a sense, which I do appreciate. But just going slightly more into their investment process. So it focuses on businesses that have sales of less than 50 million a year, doesn't target public companies, and it also doesn't want companies early on in their life cycle. So it wants plenty of cash flows, plenty of profits, not really just, potential and a promise just yet. And that fits in with the wider business model as well, because it takes those cash flows and reinvests them into the portfolio of businesses it has. It's a small business. It's less than $1 billion in market cap. And I'm going to get into this a bit later, but what I love about this is that it's a very proven business model. We've seen these kind of businesses work. They look a bit like Investor AB would be the classic in Sweden. It's kind of seen as Sweden's answer to Berkshire Hathaway, but it's a $100 billion business right now. Lifco is another amazing business in Sweden that started out small scale, and managed to use this serial acquire business model to just kind of grow and accumulate and snowball effect and start rolling downhill. And so when you see a small business with the same potential, with a similar early track record, with a promising management team that has strong capital allocation skills, you get excited. And that's why it is in Nexus One. That's why it's actually one of the best performers in Nexus One. It's about double since we added it to the service. But what it does differently to maybe a lot of the companies I mentioned there, and a lot of the companies we talk about on the show in general, is that it actually is a very active owner in its portfolio companies. So it'll create a new management team when it needs to. It's happy to work with co-owners and founders as well. But before investing in a business, that outlines a very clear strategic plan it has for that business under MedCap's ownership. And then this can be enhanced then with, the classic synergies of joining a parent company. So extra capital for expansion, or the use of MedCap's network or contacts, or even synergies with other portfolio companies if it wants to share manufacturing, if it wants to use its network, if it wants to upsell to other customers. So, and it's also actually not afraid to make acquisitions for that acquired business, if you know what I mean. So if it buys emmetsavage.com, and MedCap thinks emmetsavage.com will benefit if it buys michaelomahony.com, it'll do that. It's a kind of rushing nesting doll of sorts. So Abilia is one of its largest holdings. It's an assistive tech company. It's actually been strengthened by 10 acquisitions in its history. So there are, I think, 13 portfolio companies under the MedCap banner, but it's made 35 acquisitions in the past 20 years. So that gives it kind of taste of what we're working with here. Yeah, I talked about the decentralized ownership structure and why MedCap is going a different way. I think at MedCap scale right now, we mentioned I think it's about 7 or 800 million dollar market cap, 13 businesses. It can exercise this hands-on approach a lot easier. When we see this business in 10, 20 years, which very much hope it will last that 10, 20 years, and maybe it's, a $10 billion market cap and it's got 130 businesses, we may see that change. You know what I mean? Like, as in, it's a lot easier to manage a decentralized structure when you're that big. And this is what it comes down to as well. When like these companies scale, the difficulties arise in being able to keep up that acquisition pace and being able to the acquisitions to have the similar effect on a business. Because if you add a business, if you are a 700 million, $800 million business and you add a business bringing in 50 million euro in revenue, that immediately makes a big difference to your top line. Do you know what I mean? But if you are a $10 billion business and you add 50 million revenue, it's not going to make the same effect. So that's the challenges that's up ahead of it. So far in 2025, we've seen 3 acquisitions, which kind of gives you an idea of the scale. The portfolio businesses are continuing to deliver strong organic growth, which is very important for a whole host of reasons, obviously. But when you have that combination of organic and inorganic growth working together, can make that flywheel effect for a business. It's a very strong business model. If management can show that they have a strong record of capital allocation, which we know they do so far anyways, it's a very clear and transparent growth strategy, which I love. That's why I love seeing these businesses at a small level. Do you know what I mean? Because the potential is there, the road is there, and it becomes an execution question. So yeah, that's the things I kind of really like about MedCap at its kind of core. If you go down to like its most basic, the first principles thinking levels, smaller companies are just able to grow much faster.
Yeah.
So if you see a business
sure.
like this built with all the kind of architecture for that kind of growth long term, but it's at under $1 billion, yes, there's huge potential there. So that's what I like. And then just going into performance so far this year, because obviously it's been the best performer for Nexus I. It's about nearly doubled in the 2 years since we first pitched it. But it's actually been, a stressful 2 years in that time. It's kind of a testament to the buy and hold strategy. Surprisingly difficult stock to own, given how successful it has been. So
that's interesting. Tell me why.
So 2024 was all roses, an easy. Was up, I think, 120% in the space of a year. Me and you were geniuses for picking it. Buffett and Munger reincarnated, finding stocks you've never heard of and watching them rise. It's an easy job. But then at the start of the year, so say from January of 2025 to April, stock was basically cut in half. So its specialty pharma division got absolutely decimated in Q4 of last year to, I'm quoting this, significantly lower earnings thanks to increased competition on the British market for melatonin. So that gives you an idea of the scale we're operating at. But essentially, margins got compressed. There was inventory write-downs, and it was a big shock to the system because this stock was just up, and it was the only way. So to see that getting cut in half in the space of a couple of months, I think it let out a preliminary earnings warning at the middle of January, and the stock fell about 40% in the space of a couple of days. And like these kind of dramatic shifts, I suppose it is a micro cap, so you can be expecting this kind of volatility. But from then April to August, the stock doubled in the same space of time based off strong performance from assistive tech and med tech. And I guess that's the beauty of the diversified business model, is that the underperforming area doesn't have to be the entire pie, and other parts of the business that are not attached to it and wouldn't be affected by the macro factors affecting one aspect can bring it back up. And that's what we saw. And so that's the beauty of the business model shining through there, and that it's diversified enough for the parts that are operating well to make up for the parts that aren't. So Q3 of this year, we're back in growth mode, strong organic growth and a few acquisitions helping that. Sales growing at 20%, profits growing at 32%. and it kind of recapturing a lot of that momentum from 2024, which is very important. Probably the best thing to come out of kind of its investor relations deck is its long-term targets, which I love to see from any kind of business, but especially a small one like this. So it has a long-term EBITDA CAGR target of 15%. So basically, it thinks it's going to grow its earnings 50% year on year and year on year on year. And it also is going to try to maintain return on equity above 20% every year as well. Two really strong targets, and two really I love seeing companies focus on return on investments in their long-term targets, because not all the companies do. They'll focus on sales growth or they'll focus on profits, but like that return on investment, how we spend money, is the ultimate grade for a management team, especially for a business like this, which is investing in other businesses. And so to see that return on equity figure stay above 20% for the next decade, any company that does that for long enough is going to be a winner. It's just do that and we'll all be happy, or keep doing that, I should say, because it has been doing that in spite of what is quite a volatile year in 2025. So that's MedCap. I'm a big fan. I like the structure. I like the size. I think it's got big potential. And yeah, that's all I got.
What's not to love? Honestly, everything you said there is like music to my soul. You've got a business with a basket of 35 businesses, each of which was chosen because the management team had a view that they are going to outperform the average returns, and they will get a couple wrong. But overall, in the basket of shares, and that basket is going to keep growing. The fact that it's still sub $1 billion is huge. And to state the bleeding obvious, as they say around these parts, like a company that has $1 billion market cap, if when it grows to 10 billion, this is really investing 101, the share price has grown tenfold. So just for those people who are very, very new to stock investing, market cap and stock price are a proxy for one another. So if a company's shares go from $10 to $100, its market cap has also grown tenfold. My point, I suppose, is that small businesses grow big, and big businesses, well, they can grow bigger, but it is easier to grow from a position of a large small cap is about $1 billion, somewhere between 1 and 2 billion. Then you're moving into mid cap. But businesses at this size, the size that you have pitched, Mike, have the greatest chance of 10xing. And that's not just an opinion, that's based on data. And I think that's also a nice segue into the stock that I'm going to pitch, because coincidentally, it is also just sub $1 billion in market cap as well. So the two businesses we're about to pitch are effectively neck and neck in size, but I think that's where the comparison ends.
And I'd like to make a point just before you get in there, because you reminded me of
Yeah.
something. And this has been a trend that's happening more and more, I think, because of how lucrative the private markets are in the US. So
Yeah.
private equity and venture capital and everything else, is that businesses are coming onto the public markets larger and larger and larger in the
Oh, yeah.
US. Airbnb went public at an $80 billion valuation. Uber went public at 50 something.
Mm-hmm.
These companies would have been public companies, and investors across the globe would have been able to invest in them 20, 30 years ago. That's not the case anymore. But what is the case is these companies don't have that access. These European companies or these international companies don't have that same access to the venture capital and private markets. So they have to go to the public markets for their investment. So not only are we getting kind of bigger potential, smaller cap, and like way more of those type of companies in international markets, but they're not being ring fenced by venture capital, by private markets at all compared to the US. And this is another reason why there are so much green shoots in international markets. But sorry, go on.
It's true. And it's a very important point to make, because to find a great business that's still relatively small is a little bit harder. And I know I've espoused so many times on this podcast how I bought Netflix when it was a couple of dollars in size. Well, if Netflix was born 5 years ago, and there's no way it would have floated at this
No,
stage,
it's
whereas
a
it had,
great
yeah,
example.
exactly. It
Yeah.
is. And the same goes for Amazon. And they are out there. There are still great businesses that have recently listed or IPO'd that will grow 10, 20, 50, and 100 fold. It's just, you have to look harder to find them, I think. And I am a big fan of MedCap, and I love that pitch.
Okay. So what have you got for us?
Well, as I said, my pick is quite different to yours. It is a Bulgarian business, and it is headquartered in the beautifully named Sofia in Bulgaria, and it is called Shelly, the Shelly Group. And it is a technology company specializing in the development and the design and the distribution. I need another D: development, design, distribution, and
Uh,
discombobulation of
Sounds
the,
good.
yeah,
Delegation.
thank you, delegate, of the Internet of Things, IoT, which feels like a very 2010 thing to talk about, but it is very much on our lap now, 2025, 26, and smart building solutions for both DIY users and professionals. So the business was founded in 2010, and I'll explain what it does in a moment, and has expanded its presence to over 100 countries worldwide, with offices in Bulgaria, obviously in Germany, Slovenia, China, and the USA. And it's positioned itself as this major player, and isn't just positioned as, it is a major player in the IoT, Internet of Things, and smart building solutions. What I would also say before I dive in, I'll tell you that it scored its Nexus score in Nexus II, when we published it just over a year ago, was 90, which was the highest I think we'd seen since launching the service. Now we actually have a higher one coming up in Nexus 3. But it had a score of 90, and that
Mhm.
was
It's
pretty.
actually
Tell
two
me.
in Nexus 3 that are in the 90s, not
Ah,
just one.
oh yes. Oh, honestly, I was getting my broker ready for one of them. We never buy a stock in MyWallSt before it's published. We don't front run anything. But when I read the write up, I was like, no, please take my money. But anyway, sorry. But come back to Shelly. It's up 70% since Nexus recommended it about a year ago. And to be honest, I think it's only starting. Now, when you go to their website, it's a veritable treasure trove of domestic routers and gooters, which cause the average eyeball to glaze over in 3 seconds. But when you watch the little video there on the website, you quickly find yourself saying, I want that. That's what I want. That would make me happy. I'd be a happier person, because it shows a smart home where the lights go on and off as you move from here to there, and a lovely app, and all the things that, let's say, an up to spec home should have, and basically all the homes will have. So curtains and blinds closing at night, and lights going on if you're out of the property, and so on. And interestingly, a couple of weeks ago, I was served up a few ads on TikTok for Shelly. I didn't have any cookies for Shelly in my phone, and like, with respect, it looked like it was made by the Russian army when they were on tea break. Um, there was this 200 kilogram block of muscle telling me about the latest Shelly router and gooter, and looking into the camera, and it just knew I'm a 50-year-old dude who just like stuff. But anyway, I was like, wow, that is a remarkably bland and unappealing ad. Here, take my money. So anyway, so they do things, and if you want to have a look at Shelly's website, good luck to you, because you will see all types of switches and things that you have to screw wires into, right? Or plug into your plug and then sync with an app. But we're all going to do that, and as we said back in Nexus a year ago, it's selling into two rapidly expanding global markets: the Internet of Things and smart building solutions. The first of those, the Internet of Things, um, is estimated in multiple papers that you can get online, um, to grow from approximately $1.4 trillion in 2024, and grow at a compounding rate of up to 25% per year till 2030. And that type of industry growth is crackers. Like, to find an industry that's just going to grow 25% solidly for the next 5 years is one thing. And then the other industry they're in, which is the smart building solutions market, which includes all things to do with energy management and automation and security and connected infrastructure and everything being plugged in together and available to the people who are meant to watch these things, was valued way smaller in 2024, which is when Nexus 2 was launched, and it was valued at about 100 to 120 billion dollars, and is expected to compound at around 13% for many years to come. So the first point I'm making is that the router and gooter market for Shelly's stuff is growing in the two segments that it's targeting. which is people who are doing it at home and people who are plugging their stuff in offices. So they're going after this massive market with smart products that are easy to use and simple to set up and help people save energy and make homes more connected and customizable. If you think about it, everything now is controlled from the phone. And I think one's home is a laggard, maybe with the exception of the Ring, where you can see who's at the door if you've got a Ring doorbell. But I don't think people have their home as wired up as technology allows them to. So all things from as benign as switching off lights if you got to turn them off, to setting your heating schedule, locking your doors from your phone if you went out and forgot to do it, keeping tab on the energy use in your home. And obviously, as it's mobile enabled, it doesn't matter where you are in the world, you can do that stuff. And it's strategic expansion into international markets, in particular, German speaking countries and Italy and the Iberian Peninsula, Spain and Portugal, has really contributed significantly to growth. And at the time, Alejandro, our CTO, who is living in Iberia, specifically Ronda in Spain, at the time he said Shelly is very much part of his tech life, and they are tapping into new markets by virtue of the fact that they're all over the world. And to just kind of pay reference to some of the points you made when you're talking about MedCap, Mike, was it ticks a whole load of boxes. It's founder led. It has massive insider ownership, 60% or thereabouts, and it is relatively small. But when you look, the thing that's most magical to me about Shelly is the growth in revenue and the quality of that revenue. So the total revenues in 2019, it took 33 million into the cash register. The year after, it did 46 million. The year after, 2021, it did 60 million. The year after that, 2022, it did 93 million, then 146 million, then 208 million. And the last 12 months, it's running at about 251 million revenue. Now, just remember, in December of 2019, for that year, 2019, they did 33 million, and it's possibly going to hit the 9x on that in 2025. So revenue is just up, 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 up. And when you look then at the gross profit margin, which you have to, I suppose, consider when you're looking is it quality revenue growth? Well, the gross profit margin has improved year on year on year on year with all those years I called out. So back in 2019, it was 41%, and now it's just scratching 60%. So their gross
Wow,
profit margin has improved.
60% at that
Yeah.
speed of growth for a manufacturer like that, it's no joke.
Yes. For hardware, for stuff you need to get your hands on and plug in and screw in. So I mean that is you're dead right. When you put those two things together, it is of no surprise that Nexus identified it, because it looks for not just the score, but the trend. The trend is your friend. And that's very much hardwired into the Nexus stock selection methodology. And
I
like
think
every
that's
business.
I think that's worth dwelling on for a second, because we're talking about two businesses that I would be very impressed if anyone's ever heard of. You
Yeah.
know what I mean? And yet their performance in the last 2 years has been exemplary.
Yeah.
It's outperforming, kind of any of the Magnificent Seven by Nvidia, we'll say.
Yeah.
Um, and to do that, to find these kind of businesses is difficult to do. So
That's
I
correct.
think
Yeah.
there's an abstraction there of being like aware, yes, I need to find international exposure, but I'm still a stock picker. I still want to find market beating stocks. I still want to outperform, and I still want to have that level of research that maybe isn't accessible to me as it is in the US, because these stocks aren't talked about, 1 billionth of as much as the stocks we're talking about in the US every day and every week. And so I guess that's what Nexus does, in terms of it consolidates and compresses all that work for you.
Yeah. Yeah. That's
And then
right.
you just have one investing decision, instead of going out and having to go find these and being like, where are you going to
Mm.
find a Bulgarian IoT specialist growing revenue at, you know, ninefold in the space of 6 years? Like, it's just not something an average investor can do or has the time to do. And that's, I suppose, is the beauty of having the technology we have, and the expertise that we've put into this product, and it iterating over 3 years as well. It's gotten better and better. So Yeah, that's just another reason why I believe it's a very important product. And if you're a serious investor, if you're looking to kind of not bulletproof your not bulletproof your portfolio, but make sure it's diversified and less US based, I think is a very important product, and it's going to do an awful lot of heavy lifting for you.
Perfectly well said. I mean, when we consider MyWallSt suite of products, which we do very carefully all the time, because our frenemies and our competitors will release product after product after product, because in our industry, the money is in the launch. And I could name wonderful businesses in our space that have launched 60 services in the last few years. We have 4 products. If you exclude this podcast, which is a product, but really it's infotainment for people, we have a very basic entry level product called Stock of the Month, which is what it says on the tin and outperforms so many things. We have Profit, which is for those people who just want 5 minutes a month. We have Horizon, which is the Follow Me service run by me. And we're talking about Nexus here, which is for the international focus. And as you said, like who would ordinarily find a tech giant in Bulgaria if they existed? So I think it is, or indeed a serial acquirer up in Stockholm. So it's a product we're very proud of, and I think it needs to be said that it is going to shine a light on some businesses that are highly unlikely you'll have ever heard of. As I said,
Yeah.
those 2 that are scoring 90 going live on Monday is just, I really, they are pretty unbelievable. One of them has margins, gross profit margins of over 90% year in, year out. I mean, honestly, anyway, it's not about that. So there we have 2. So before we move on and do a little votaroo on whether we're going MedCap or how we'd split 10 grand over those 2 stocks. Like everything, there are risks. And the risk I see with Shelly is that the IoT space is hot, it's crowded, it is there's so many giants who are looking to take control of your home, whether it is
Yeah.
Amazon with their Ring did they buy iRobot? No, there was someone who nearly bought iRobot and it fell through, but kind of this kind of they want control of your home. Like Philips are there, Amazon is in there, Apple is in there. So like it's not like you've small competitors, you've very serious competitors. And I think Shelly are trying to differentiate by saying, look, this is our core speciality. We keep it simple, we keep it elegant. The technology is moving fast. So that's another risk. They need to make sure that the boxes they send to your home and the switches that you're using don't suddenly become redundant or dated or need upgrading in an onerous way. And then finally, just all the usual supply chain stuff like tariffs and government regulations and the likes. But I think that's just table stakes. So they are the main risks for Shelly. But when you look at the trend is your friend and their position in the market and this big block of muscle who's going to pop up on your TikTok now that you've listened to this podcast to tell you to buy a Shelly switch. Like they are doing something good and they're doing it extremely well. And to my eye, they are an undervalued hidden gem in the middle of Bulgaria.
Yeah. You said something there, and actually, do you know what? Well, let's start spending our money because I'll bring it up there. It's probably more appropriate.
Okay, well, who go first?
I'll go first. You've been talking for too
Right.
long.
Yes, that is true. No one ever says that. Said nobody ever.
Okay. So if I had 10 grand and I was looking to invest for 10 years, I think I would push 7.5 grand in MedCap and 2.5 in Shelly. And that sounds worse than it is, but I'm going to give you one reason why. And that's because you mentioned the kind of companies that are in the smart home space in particular. I feel like Shelly could become a acquisition target for a much bigger company and such that would, over the space of 10 years, if you're maybe, I don't know, Amazon wants to come in and buy it in 3 years, you're curtailing an awful lot of potential there. That would be kind of a long-term risk I might see for Shelly in terms of there might be a ceiling. So hence why I would tip the scales for MedCap, which is a business I love and the kind of structure of a business I love. So it's coming up against tough competition anyways. This doesn't take away from your pitch.
No, and I thank you for that. Well, believe it or not, when I decided to buckle down my numbers before you started to speak, so I wouldn't get any kind of confirmation bias or otherwise, but I put 85%, 8.5 grand into MedCap and 15% into Shelly, 1.5 grand, for the reasons you explained. I think MedCap is a business that, so I think Shelly is more likely to deliver short-term gains. I think its longevity equation is more questionable. I think MedCap is just going to roll and trundle along and make. Soon we'll find that it doesn't have 35 businesses in its folio; it has 45. And if they have a good management team committed to the long term, which I understand and believe they have, that 45 will become 100 companies in their folio in the fullness of time. And I think it is a wonderful business. I think we think Shelly is a great business, but I think MedCap is a wonderful business.
Yeah, yeah, and the thought process of, say, how we frame that question in terms of leaving money for 10 years, not seeing it
Oh yeah,
again, and turning back up.
yeah,
There's something about leaving it in the hands of an investor or an investment team in terms of the management team that's proven its track record
yeah,
and proven it can achieve high returns on investment so far, that it just want more of the same. And I've said this a lot when I talk about these type of businesses, because the track record is very important there, but all we want is more of the same. And so it almost feels like you're leaving money with a money manager of a kind, instead of, like, say, Mark Zuckerberg, who wants to go all in on the flipping metaverse and
yeah.
destroyed hundreds of billions of shareholder value in the space of a year. So there is that kind of like, okay, well, no, they're out to make smart, astute investment decisions based on the rate of return they believe they can achieve with the money you basically give them. So for that reason, I think
Entirely.
it's an easy business to hold long term. So yeah.
It was like when David Gardner was on Stock Club here a few weeks ago, and I asked him what stock would he buy if he was going to a desert island for whatever 20 years, a long time. And to my own surprise, he said, "Well, I wouldn't go for the types of stocks I espouse one investing in if they're actually still back here, not on a desert island." He said he'd go with Google, or I think he said he'd go with Google, but a solid compounder that's just going to do well, that when he comes back from the desert island, he knows his capital is safe. And I believe that that's just, I suppose, a reflection of the point you just made. And I do believe that MedCap is going to be a set it and forget it, throw it under the mattress, see you in 10 years, thanks.
Okay. Okay. I think that's covered everything now. Yeah, I think it's worth reiterating the importance of international diversification and diversification in general. This isn't a scaremongering episode. This is not supposed to go down that route at all. But, you know, everyone is talking about, in some form, waiting for the coin to drop with the US market, whether it be the AI bubble or it be something else. Like, valuations have gotten extended, and people think that's okay. Well, maybe I need to sit on my hands. Well, maybe you don't. Maybe you need to look for places where valuations have not gotten extended, where there's still deals out there, where there are companies going public at $500 million market caps, which have huge potential and which will be doing all their growing on the public markets, not in the private markets. And I think that's an important distinction. I think these two businesses, if they were American, we wouldn't see them until they become $20 billion
Mm.
companies.
Yeah,
Do you know what I mean?
absolutely correct. Yeah, but they'd be way harder to see, especially MedCap, because serial acquirers are a dime a dozen, but quality ones are a rare find. And I think that is a really quality serial acquirer.
Okay. On that, I think we'll call it a day there. Emmet, thank you for joining me. And thank you, everyone, for listening in. Just a reminder, if you are interested in Nexus 3, which you get Nexus 3 plus Nexus 2 plus Nexus 1, all in one beautiful package. If you want it, we're giving it for half price. All you have to do is email frank@mywallst.com. That's MYWALL. Let me do that again. MYWALLST.com. I hope that was clear. Thank you for joining me, and we'll talk to you next week.